Earlier today, Berkshire Hathaway filed what's called a Form 10-Q with the Securities and Exchange Commission. That's their quarterly financial reports. And in it, we learned a couple of interesting things. One, Warren Buffett, on behalf of Berkshire Hathaway, has been selling some stock, a lot of stock, and they've now got more cash than ever. And so in this video, what I thought I'd do is first sort of show you what happened, what Warren Buffett has been up to in terms of selling stock, and one could even say hoarding cash. So what's going on there? Two, we're going to try to understand maybe why he's doing it to the extent, that's possible. But then three, maybe more importantly, we'll try to answer the question, what should we do? Should we be selling our stocks or our index funds and piling up with cash? That's the three things we're going to try to accomplish in today's video. So let's dive right in. Let me first show you the headline. This is from CNBC. And they've even got up here in red, Warren Buffett raises Berkshire cash level, $277 billion. That's a big number. And one of the big things he sold about 50% of Berkshire Hathaway's stake in Apple. Now, as longtime viewers of this channel know, I too own Apple. It's my single largest holding. And I also, full disclosure, I also own shares of Berkshire. Those are the only two individual companies that I own. Everything else we have are in different kinds of index funds and whatnot. But we do own Apple and Berkshire, and he sold nearly half his stake in Apple. Now, he had sold a big chunk of Apple, not nearly that big, but he'd sold a big chunk of Apple earlier in the year, and it was actually a subject of discussion during the Berkshire annual meeting in Omaha, and we'll actually come back to that in a minute. So where does this information come from in terms of what he sold? Well, eventually, they'll file what's called a Form 13F. It's due, I believe, 45 days after the last quarter, which would have been June 30th. So maybe in the next week or so, we might see the 13F, which gives you more details about a company's stock holdings. But there's information in the 10Q that shows us, at least to some extent, what's going on, and I can show you that here. And I'll leave links to all of this below the video. So this is their 10Q that they file, and what we want to look at is actually on page, I believe it's page 9. Maybe. Oh, here we, that's 8. Here we go. You got to go to the footnotes. This is note 5. And this is investments in equity securities. This is for June 30th of this year. So that was when their quarter ended, just, I guess, a little over a month ago. But you also see numbers from the end of last year. And here we can see at the end of last year, we'll start there. They mentioned their 5, right here in this footnote or asterisk, the 5 companies that they had the most in. American Express, Apple, Bank of America, Coca-Cola, and Chevron. Those were their 5 largest holdings. And we can see with Apple at that time, right here, $174.3 billion. Now that was the end of last year. Now, you fast forward to the end of June, and that stake is down to $84.2 billion. Now, of course, Apple's been up this year, I think about 14%, but clearly you had to sell a lot of shares to go from $174 billion down to $84 billion. Now, it's still their largest single holding, but yes, they sold a truckload of Apple stock, and this isn't reflected in this 10Q, I don't believe. But more recently, news has been that Berkshire's been selling a lot of their Bank of America stock as well. And then, if we go back to the news article I showed you just a second ago, all of this results in a big pile of cash. So they've got, as you can see here, $277 billion in cash. So that's kind of what happened. Now, the next question is, can we figure out why? And the short answer to that, I think this is really important, is no, we can't. I mean, we can speculate, which is what I'm going to do, but they don't, Berkshire Hathaway and Warren Buffett typically don't say, here's why we're doing what we're doing. And so there's been no public announcement or release that I'm aware of, or statement by Berkshire or Mr. Buffett to say, here's why we're selling Bank of America stock lately, here's why we sold half our stake in Apple in the last quarter. So it really is speculation, but we do know a few things that aren't speculation. First of all, we know from the annual meeting this past year, because he was asked about this, he said Apple is a great company. In fact, one of the questions was, hey, You've often said that American Express and Coca-Cola are two of your forever companies. You're not going to sell them. And why isn't Apple in that group? And he had a great response to it. In fact, I'll dig up that video and I'll leave a link to it below this video. But what he said was, look, Amex, Coca-Cola, great companies. He described Apple. He said, Apple, an even better company. But sometimes, you need to sell some shares. And one of the things he said in that answer, he talked about taxes. And he said, right now, Berkshire, when it sells stock and has to recognize a gain, it pays federal income tax to the tune of 21%. But what he noted was that's actually down from what it was in the past. I think he said at one point it was 35%. At one point it was somewhere around 50%. But he made a point that it's likely that tax rate's going to go up. Now, he didn't predict when. Of course, we've got tax laws that are in place now that will automatically change beginning in 2026 unless our government steps in to prevent that. And of course, depending on who wins the election in November, whether it's and if either party controls the White House and Congress, there could be tax changes. But of course, we don't know. But his point wasn't, I don't think, specific to the election. It was more general that says, look, we're taking on a lot of debt in the United States. They're going to have to deal with it eventually somehow, and that's likely going to involve higher taxes, at least for corporations. And I think his point was, would you rather pay the 21% now or a much higher rate later? Now, that at least opens the possibility that part of what's motivating Berkshire Hathaway and Warren Buffett is to take advantage of relatively low tax rates. And in that regard, it's the same thing you and I would do, right? I mean, that's exactly what we try to do when we do a Roth conversion. We're hoping we can pay lower taxes now rather than higher taxes later. So nothing out of the ordinary there, but I think it could be one of his motivating factors. Another possibility is that Apple was an extremely large stake. Now, Warren Buffett is certainly not afraid to put a lot of chips in one company. He's done it in the past, so he's not one to get nervous about that, I don't believe at all. But there could be some part of this that's just managing the capital of Berkshire Hathaway, and that maybe there was a view that they needed to just cut back. The stock has done extremely well. It's done extremely well for Berkshire. It's done extremely well just this year alone, and maybe there was this sense that it was time to pull back a little bit. And we also are at really high valuations. Let me show you this. This is the Shiller PE ratio. And it's been high for a long time, frankly. You can see we're at 34 now. The mean is 17. It hasn't been, by the way, 17. I was looking at this earlier since like 2009. So it's been above average for a very long time. And by the way, this even encompasses this big drop, right? You know what that is? That's COVID. But even with COVID, it was still, the lowest it hit was around 28, well above the average, and now it's back up to 34. And there could be some indications in the economy that possibly we're heading towards a recession, maybe. It's not a prediction on my part, but a lot of folks have started to talk about that, giving unemployment numbers and other things that folks are seeing. And so it may have been just a desire on the part of Warren Buffett and Berkshire to take in some more cash. Of course, as an operating company, it needs a lot of cash. It's got large insurance operations, for example. It also owns businesses like utilities and railroads that require a tremendous amount of capital to invest in those companies. And so they're going to have a lot of money, even in the best of times. But when you add all of this together, it seems sensible to me that they may have wanted to sell some stocks. And it made sense perhaps for Apple because it was the largest holding, still is the largest holding, by the way, but it was the largest holding. They'll pay taxes at a relatively low rate and likely lower than they may pay in the future. Of course, no guarantees on that. So when you sort of add all of this up, it seems to make sense to me that they've done what they've done. I think the fact that they've sold 50% of Apple can be a bit jarring. But, they had a large amount of Apple to begin with, and they're still left with a huge stake in the company. All right, so that's kind of maybe what's motivating Berkshire and Warren Buffett, but of course, that's just, my best guess. So the big question then is, what should we do? Well, I can tell you what I'm doing and what I'm not doing, and why. First of all, I'm not selling any of my stake in Apple. Why? I just don't view Warren Buffett's sale, even of a large part of Berkshire's stake in Apple, as any indication that he sees a problem with the company. He said just a couple of months ago, as I mentioned at the shareholder meeting, that it's a great company, even better than his long-term holding companies, American Express and Coca-Cola. I don't see anything that's changed with Apple over the last couple of months. And just generally, I don't see any reason to sell, other than one could argue it's very richly valued. But that's true with just about all stocks, certainly large company stocks in the United States. If I were going to sell for that reason, I guess I'd have to get rid of all of my U.S. company index funds as well, and I'm not doing that either. So also, I will say that I'm comfortable holding that stake, if needed, a long time. I don't see a need to sell the Apple stock anytime soon if I don't want to. If I knew that I had to sell in the next year or so, I'd probably sell now because it's at a very good price. But that's just not the case in our situation. So I'm not selling my Apple stock just because Warren Buffett sold 50% of Berkshire's stake. That's number one. Number two, I do think that it's a mistake to get too comfortable with the way the stock market has generally performed over the last, frankly, since the Great Recession. If we go back and look at this chart again, if the Great Recession is here, we've had a lot go on over the last, what would that be, about 17 years? Has it been that long? 16 years maybe? We've had a lot go on, including COVID. But the trend, and this is of course the PE, but we could look at a stock chart of, say, the S&P 500, and you'd see it going up just like this as well. And during that time, except for a couple of months following COVID, we haven't had a recession. Think about that. We have not had a recession since the Great Recession, 15 plus years ago. That is a really long time to go without a recession. We've got stock valuations, certainly if we think of large U.S. company stocks, at very high valuations. And so one of the things I'm always doing in that circumstance is rethinking my asset allocation. Do I want to make changes to it? Or more likely, do I just want to make sure I'm rebalancing? Now, in my case, I'm not making any changes to my asset allocation. I'm generally around 75% stocks, 25% bonds. By the way, the reason I say generally is because I often think about that within a range, and sometimes a large range, like in my case, 70 to 80. Why do I do that? It's because I don't want to rebalance a lot, frankly. And so I don't rebalance a lot. And if it goes from 75 to 77, and then down to 73, and then up to 78, and back to 75, I tend to just let it go. I'm not going to trigger rebalancing frequently. I just prefer not to. But the point is, when stock valuations are high, I am making sure that it's not drifting up towards the top of that range. Now, at the moment, it's not. My allocation of stocks to bonds, and in that I'll include cash as part of bonds, I've got about 72 to 73% stocks. So I'm sort of on the low end of my range. I like that. If I were at 80%, I would be rebalancing. If I were at 78%, I'd probably be rebalancing. Stocks are richly priced. That's not a prediction that they're going to go down tomorrow or next week or next month or even this year. It's just an observation. They're based on historical terms, highly valued, and so I'm going to want to, at least be in the middle of my range, if not a little bit lower. But it turns out I'm kind of right where I want to be, and so I'm not making any changes there. But I'd certainly say, particularly since stocks have generally been up, it's a great time to make sure your stocks haven't gotten beyond what you're comfortable with in terms of your asset allocation, and rebalancing if it makes sense. The other thing that I'm doing is making sure that I have all the cash that I need for my expenses, and I generally think over the next year. Now, I'm speaking as someone I'll call myself semi-retired. Certainly true if you're retired, as many of the viewers of this channel are. If I'm going to need cash over the next 12 months, and I know I'm going to be taking that from stocks, I'm generally going to want to take it when I think the markets are high, if I have that option right now. And right now, of course, last week the markets were down. It was had a couple of rough days, but still, generally, stocks are up this year. And even apart from what they've done this year, again, going back to the Shiller PE, they're pretty richly valued. That doesn't mean they won't go up. Maybe they'll go up more this year, but I would be very comfortable pulling out stocks that I needed to convert to cash, if that's the case, as part of my retirement spending and my retirement planning. And then the other thing I like to do when stocks are sort of richly valued is think about any charitable contributions I want to make, because we contribute, it's generally Apple stock, to a donor-advised fund. That's what they're called. It's the way we give to charity. Now, in our case, we've already done that. Earlier in the year, Apple was at a great price. I don't remember if it was as high as it is now. It may not have been. I can't recall, but it was at a good price. And I kind of did the same thing I'm describing right now. And I said, okay, I like that. Let's go ahead and use this as a time to send some shares over to the donor-advised fund for our annual contribution. So we've already done that. But that's the kind of thing I would be looking at in circumstances like this. The final thing I'll say is that I do believe we'll be in for a difficult market. I don't know when. I don't know if it'll be this year or next. But as I mentioned, other than a short blip during COVID, we haven't had a recession since 2000 and I guess it was 8 into perhaps 2009. But since the Great Recession, the stock market has basically just been going up since then. Obviously, there have been things like the end of 2018 into 2019, and of course, a few months during the start of COVID when the markets were down significantly. But overall, markets have been up significantly, at least in the U.S., since the Great Recession. And so I suspect at some point in the not distant future, again, it's not a prediction of when, but I would suspect a recession wouldn't surprise me. And the impact that has on markets wouldn't surprise me if we had some difficult years in the stock market. Is that causing me to sell my stocks? No. Is it causing me to make sure my asset allocation is where I want it to be? Absolutely. Is it causing me, which by the way, you should be doing that anyway, but this, kind of a reminder for me. And also, again, just making sure as a semi-retired person that we have the cash we're going to need on hand to meet the spending that we project over the next 12 months. So there you go. That's what's going on at Berkshire Hathaway. My best guess as to why, and then what I'm doing about it, which frankly is not much other than just making sure things are where they should be in our investments. In our case, they are. So good to go. No changes here. Let me know what you're doing, if anything, in response to all of this. You can leave a comment below this video. And until next time, remember, the best thing money can buy is financial freedom.